Big earnings week this week. It's basically Christmas for big tech investors, and we have companies like Apple, Facebook, Google, Microsoft already reporting, with Amazon reporting today. And then also I have companies like Teladoc and FLWS.com that are in the portfolio that I also want to talk about. So in this video, we're going to do some highlights on the earnings and kind of my opinion on what's going on with all these companies. First up, let's talk about Apple, who absolutely smashed earnings according to the revenue beat and earnings per share. I mean, you're looking at $90 billion delivery versus 77 expected, earnings per share of 140 versus 99 cents expected, and it's really growth across all the segments. So iPhone, Mac, iPad, you name it, they're all growing at really good rates versus last year. When I first saw those results, I thought Apple was going to shoot up, 4 or 5%. And it was up after hours, but on the open the next day, it's relatively flat. So the market, I guess, isn't too excited, but realistically for me, it was good earnings. Also in their press release, they announced a dividend increase of 7%. And look at this, $90 billion going back in share buybacks.
$100 billion!
Finally, they're using some cash and returning some value back to shareholders. My overall opinion on Apple really hasn't changed. It's in the portfolio, I'm still holding it, but I'm not going nuts buying into it at these levels. Even though the growth and earnings were really good, I don't expect the growth to be that good to over deliver on this PE ratio that's currently 36. There's already growth priced into Apple. Realistically, I see better opportunities in smaller cap companies. Next up, we have Google, or company Alphabet. Kind of the same story with big tech absolutely crushing it. Revenue came in at 55 billion versus 51. Earnings came in higher than expected. And across the board, in terms of revenue, they saw growth in their core business of ads. And specifically, I like to see the YouTube ads growing. Part of the reason I'm so excited about Google is YouTube itself. I think that will continue to grow and be a great platform for the company. And then the other thing that was nice to see is that the margins were actually expanding as well, getting to around 30% in terms of operating margin versus 19% the year before. And realistically, there was a little impact from depreciation rules changing and them extending useful life of some assets, but overall operating margin going up means more profit to the bottom line for the company, and you can definitely see that come through with the net income. And Google is also getting in the party of stock repurchasing, with about $50 billion authorized to buy back shares. Compared to Apple, Google actually went up after earnings, which is nice to see after an earnings beat. For me, Google is still a hold in the portfolio. Then we have Facebook, and look at that. They also beat revenue. It's almost like all the big tech companies are absolutely just killing it right now. And earnings per share, once again, also came in much higher than expected. That's definitely due to the operating margin expansion to 43% versus year over year of 33%. I mean, you're talking about 1,000 basis point improvement in the profitability of the company. Something I like to see in terms of the monthly active users and daily active users, basically anything to do with how many people are using the platforms, was up year over year, which is good to see. I mean, they're not crazy numbers, but it's kind of the law of large numbers, where the more users you have, at some point going to be saturated. Everyone has a Facebook. They kind of have to expand probably to other platforms in order to grow that number significantly. And then the other thing that they mentioned was that the headwinds could possibly be with iOS upgrades. The ability to target people for ads may go down in the future. So definitely something I'm looking at in the next quarter to see if they actually put a number to it. Right now, they basically just called it out. Something to look at. In terms of price action, Facebook definitely saw the best results, being up 7%. And that's definitely due to the fact that the company has been valued differently versus the big tech companies. I've been saying that it's the most undervalued big tech company, and I think part of that is because the company itself is probably hated amongst a lot of investors.
Let the hate flow through you.
With that hatred probably comes a little bit of a discount, but that's okay. I buy into the hatred, and more power to Facebook, I guess, for getting a discount for that. Well, anyway, with continuous earnings beats and profits growing, at some point the market starts to not care about all that other stuff and you see the shares go up. Microsoft was slightly a different story. The revenue came in line, the earnings per share came in line, but even though the results were impressive, because they hit expectations, the market actually reacted negatively, but not too much. I mean, the shares were down a few percent, and realistically, Microsoft is still a juggernaut when it comes to playing the kind of digital transformation across businesses. It's got the cloud, it's got all of the productivity and business enterprise. I mean, this thing is pretty well diversified, and as you can see, if you look across the market segments that they operate in, they're all growing at a decent pace. They're also increasing their income year over year. Microsoft continues to be one of my bigger positions, and I think they're very well positioned for continued growth and a great play on the cloud. One of the newer positions in the portfolio, Teladoc, definitely took a hit. Now the price is back around that 170 level. It seems like growth in general has been getting hammered. So if you look at Pinterest, Spotify, these companies that are growth companies and have some premium built in, have been getting taken down even after kind of meeting expectations. What Teladoc didn't do very well was the earnings per share. You can see a $1.31 loss versus 54 cents expected, but their revenue came in line. So pretty much that just means that their bottom line, they're not controlling the expenses as well, and they're still just focused on the revenue growth. For me, when I bought the stock, it was really about looking at the revenue growth. So my assumptions were based on $2 billion full year 21. They restated that guidance, so I'm really looking at the revenue growth and making sure that every earnings that comes out, they're kind of on pace. If that's the case, this 170 level, I feel like they're still fairly valued. Then we have Flowers.com absolutely smashing their earnings, being one of the recent additions to the portfolio. It's good to see that revenue coming at 474 versus 393, and then earnings per share was actually a gain expected to be a loss. So they actually swinged to a profit in a quarter that they normally lose in. So obviously they're still getting some benefit from the COVID effect in this first quarter. What I like to see was that they guided full year revenues to around $2 billion, and so my price target around 33 still is intact. They also announced a 40 million buyback for shares, so they beat revenue, they beat earnings per share, announced a share buyback, and gave great guidance. Very happy with the Flowers.com earnings. Happy to see earnings in the future, and hopefully we can get to that 33 price target. Because yeah, currently the stock is trading around $29.50, and it jumped around 19% as of now after earnings. So earnings were good, and the market reacted positively. Now, another thing to mention about Flowers is the fact that it is shorted, actually kind of on the heavier side, which may add some fuel to the fire. Because the earnings were good, this might catch some shorts on the wrong side of things, and it may give it a little boost here in the near term. And taking a look at Amazon earnings live, it's up about 3% after hours on news that they did beat earnings, as the earnings per share came in around $15.79 and expected was $9.54. So they beat there. Their net sales increased 44% over last year's quarter. Pretty much across the board, they absolutely are killing it everywhere. So the thesis with Amazon just continuing to dominate and grow at an extremely fast pace is still intact. Now, the real question is how much of that is COVID related and how much of it will go away. That's kind of what we'll probably find out over the next couple quarters as the economy reopens. But in my opinion, I think, the growth isn't going away. The acceleration for e-commerce and the growing markets in the cloud are not going away. So I think Amazon will continue to dominate and continue to grow. As for the rumors around an Amazon stock split, I didn't see anything. Maybe they announce it in the earnings call, but I guess we'll find out. And hopefully you guys enjoyed this video, a little different, going over the Q1 results for big tech and a couple other names in the portfolio. If you did enjoy this video, give it a thumbs up and consider subscribing to Main Street Wolf. Thanks guys for watching, and have a great day.